Let's get in a fundamental voice of the market's unabated uptick. What are domestic money managers doing? Is it a good time to still put in money or now stay safe? To talk about that and his outlook per se for the market, Sanjay Sinha, founder of Citrus Advisors, joins us right now on the phone line from Mumbai. Sanjay, good to have you. Thanks so much for joining in. I mean, really the pertinent point, above 5,600, it's one more day wherein we've done well, and the options activity seems to suggest that we'll go higher. From a fund manager's perspective, with the quantum of funds that you may have, what is it that you're looking to do in the markets right now?
See, if the perspective is extremely short term, then in the background of the fact that we have rallied by almost 25%, there will be an obvious temptation for most of the market participants to take some profits off the table. But then that is only the short-term perspective that you can have. What I believe is that given the fact that we now have fair amount of positive developments on the government policy front, which was one of the major negatives for most parts of 2011. Now that it is out of the way, I think there could be more triggers that will come from the government also to support the market. On the other side, if you look at the outlook from an institutional investor's point of view, and where the foreign institutional investors have a fairly large role to play in the market. In 2011, when you had so much of pessimism with policy, all that they have taken out net is 4,500 crores. So in 2012, when your interest rate cycles are peaking out and are likely to now move southwards, and you have a possibility that the government policy will become more positive from the macroeconomic perspective, I think there is a strong possibility that more money may come to India than go out in the short term. And therefore, the short-term correction might just be an opportunity to either increase your allocation to equity, or if not already allocated, or you can simply move around in sectors.
And that conviction, Sanjay, strengthens with the fact that external risk has also reduced, or at least has been spread out with the bailout package approved for Greece today?
I think that definitely is one of the things which has been a support to the rally, because the market was on the tenterhooks till the end of December as to what is going to happen to Europe. And I think this extremely strong second bailout package of about $113 billion is a strong affirmation that, at least the entire Europe is rallying around to find a solution to the crisis. Now, whether this second bailout package will address this issue in entirety, I think that is something time will tell. But at least there seems to be a fairly strong intent to solve the crisis.
Fair enough. What about finding value in this market, Sanjay? What would you be picking in terms of just themes and also stocks, especially given the rally that we've seen or the outperformance we've seen in the broader markets?
If you look at the valuations in the perspective of where the earnings outlook currently stands, it would be very difficult to defend a rally beyond this point purely on that account. But I think if you go back and see as to how the markets have normally behaved in the past, the markets fall first and then the earnings downgrade happen. And conversely, the market rallies first and then the earnings upgrades begin to happen. I think in 2012, it is quite likely that the markets may rally first and the earning upgrades may follow after that. And therefore, I would say that Indian markets, if you want to enter today, it is fairly valued, but then you need to have a positive outlook. In that background, if I have to take a choice of sectors, I would probably play the contrarian and take sectors which have been more beaten in 2011, maybe are more interest rate sensitive. And therefore, my choices would be banking, auto, and infrastructure.